Welcome back to Wealthwing, where we pull back the curtain on the financial strategies that actually build wealth. I'm your host, and today we're diving into something that might make you a bit angry at first, but stick with me, because by the end of this episode, you'll know exactly how to use these same strategies yourself. We're talking about tax loopholes. Now, before you roll your eyes thinking this is another offshore accounts and shady dealings episode, it's not. Everything we're discussing today is 100% legal, IRS-approved, and sitting right there in the tax code for anyone to use. The problem? Most people don't know they exist. Here's the truth that nobody wants to say out loud. The tax code wasn't written for the average W-2 employee. It was written to incentivize certain behaviors, like investing, creating jobs, and building businesses. And the wealthy? They've mastered the art of structuring their finances to take advantage of every single incentive. Today, I'm going to show you 7 of the most powerful tax strategies that wealthy individuals use to legally reduce their tax burden, sometimes down to 0. And yes, you heard that right, 0. But first, let me hit you with a quick disclaimer. I'm not a tax professional, and this isn't personalized tax advice. Always consult with a qualified CPA or tax attorney before implementing any of these strategies. What we're doing today is education, opening your eyes to what's possible. Ready? Let's dive in.
Let's start with one of the most powerful tax strategies in existence, real estate professional status. This is how many wealthy individuals pay little to no taxes despite having massive incomes. Here's how it works. Normally, rental property losses are considered passive losses. You can only deduct them against passive income, not your regular salary or business income. But if you qualify as a real estate professional, those losses become active, and you can deduct them against any income. The requirements? You need to spend more than 750 hours per year and more than half your working time in real estate activities. That's about 15 hours per week. And here's the kicker. Real estate activities include managing properties, finding deals, researching markets, and even learning about real estate investing. Let me paint you a picture. Say you're a high-income earner making $500,000 a year. You buy a rental property for $1 million. Through depreciation alone, which is a paper loss, not actual cash out of pocket, you can deduct about $36,000 per year. Add in mortgage interest, property taxes, repairs, and management fees, and you might show a $60,000 loss on paper. As a real estate professional, you can deduct that entire $60,000 against your $500,000 income. That's a tax savings of roughly $22,000 at a 37% tax rate. And that's just from one property. The wealthy often own multiple properties, creating massive paper losses through depreciation while the properties actually appreciate in value. They're building wealth while reducing taxes. It's brilliant. Now, you might be thinking, but I have a full-time job. Here's a strategy. If you're married, one spouse can pursue real estate professional status while the other maintains traditional employment. This is exactly what many wealthy couples do.
Loophole number 2, the Augusta Rule. Rent your home to your business. This next one is so simple it's almost laughable, yet most people have never heard of it. It's called the Augusta Rule, named after the Masters Golf Tournament in Augusta, Georgia. Section 280A of the tax code says you can rent your personal residence for up to 14 days per year, and the income is completely tax-free. You don't even have to report it. Originally, this was created so Augusta residents could rent their homes during the Masters without tax consequences. But here's where it gets interesting for business owners. You can rent your home to your own business for meetings, photo shoots, or company events. As long as it's a legitimate business purpose and the rate is reasonable for your area, it's perfectly legal. Let's do the math. Say you determine the fair rental value for your home is $1,000 per day for business events. Not unreasonable in many markets. You rent it to your business for 14 days throughout the year for strategic planning sessions, team meetings, or content creation. That's $14,000 in tax-free income to you personally, while your business gets a $14,000 deduction. If your business is in a 21% tax bracket, that's an additional $2,940 in tax savings. Combined, you've just created over $16,000 in tax benefits. The key is documentation. Take photos of the events, keep sign-in sheets, and have agendas. And always charge fair market rates. The IRS can challenge unreasonable amounts.
Loophole number 3. Conservation easements. Now we're getting into territory that requires some serious assets, but the tax savings can be astronomical. Conservation easements are one of the favorite tools of the ultra-wealthy, particularly those who own large properties. Here's the concept. You donate the development rights of your land to a qualified conservation organization. You still own the land and can use it, but you've permanently restricted future development. In exchange, you get a tax deduction for the value of those development rights. Let me give you a real example. Say you own 100 acres of land worth $2 million. A qualified appraiser determines that without development restrictions, the land could be worth $5 million to a developer. By placing a conservation easement on the property, you've donated $3 million in value. You can deduct up to 50% of your adjusted gross income, 100% if you're a farmer or rancher, for up to 16 years. So if you make $500,000 per year, you could deduct $250,000 annually for 12 years, completely wiping out your federal income tax liability. The beautiful part? You still own the land. You can still live on it, farm it, or use it for recreation. You've just promised not to develop it into a subdivision. Now, there have been abuses of this strategy with inflated appraisals, so the IRS scrutinizes these carefully. But when done properly with legitimate conservation purposes, it's a powerful tool.
Loophole number 4. Oil and gas investments. This one might surprise you, but oil and gas investments come with some of the most aggressive tax benefits in the entire tax code. Why? Because the government wants to incentivize domestic energy production. When you invest in oil and gas drilling, you can deduct 60 to 80% of your investment in the first year through something called intangible drilling costs, or IDCs. These are expenses like labor, chemicals, and other costs that have no salvage value. Additionally, 15% of your investment qualifies for the tangible drilling costs deduction, which can be depreciated over 7 years. Combined, you're looking at deducting nearly 100% of your investment over time. Here's what this looks like in practice. You invest $100,000 in an oil and gas partnership. In year 1, you can deduct $70,000 as IDCs. If you're in the 37% tax bracket, that's $25,900 in tax savings immediately. The remaining $30,000 in tangible costs provides additional deductions over 7 years. But wait, there's more. Once the well starts producing, 15% of the income is tax-free through something called the depletion allowance. It's like depreciation for oil and gas. The catch? These are typically high-risk investments. Many wells don't produce as expected. But for high-income individuals looking for massive first-year deductions,
The tax benefits can outweigh the risks.
Loophole number 5. Defined benefit plans. The pension hack. Most people know about 401ks with their $23,000 annual contribution limit, but the wealthy use a different playbook, defined benefit plans, also known as pension plans. These plans allow contributions based on the benefit you'll receive in retirement, not a fixed dollar amount. For high-income business owners over 50, annual contributions can exceed $300,000. Yes, you heard that right. Over $300,000 in tax-deductible retirement contributions in a single year. Here's how it works. Say you're a 55-year-old business owner making $500,000 per year. An actuary determines that to provide you with a pension of $250,000 per year in retirement, your business needs to contribute $320,000 this year. That entire $320,000 is deductible to your business. If you're taxed at 37% federal plus state taxes, you've just saved over $140,000 in taxes this year. The money grows tax-deferred, and while you'll pay taxes in retirement, you'll likely be in a lower bracket. The best part? You can have a defined benefit plan alongside a 401k, allowing even more tax-deferred savings. This is how many wealthy business owners build massive retirement accounts while zeroing out their current tax bills. The downside? These plans are complex and expensive to administer. You need actuarial certifications and annual filing requirements, but for high earners, the tax savings dwarf the costs.
Loophole number 6. Charitable Remainder Trusts. Have your cake and eat it too. This strategy is pure genius for those with highly appreciated assets. A Charitable Remainder Trust, or CRT, lets you donate assets to charity, get a tax deduction, avoid capital gains taxes, receive income for life, and leave a legacy. It's the ultimate win-win-win-win. Here's how it works. Say you bought stock for $100,000 that's now worth $1 million. If you sell, you'll owe capital gains tax on $900,000, that's $180,000 at a 20% rate, plus state taxes. Instead, you donate the stock to a CRT. You get an immediate tax deduction for the charitable portion, typically 10 to 50% of the value. The trust sells the stock tax-free and reinvests the full $1 million. You receive income from the trust for life, typically 5 to 8% annually. Let's run the numbers. You donate $1 million in stock to a CRT. You get a $400,000 charitable deduction, saving $148,000 in taxes at a 37% rate. The trust pays you $60,000 per year for life, 6%. After 20 years, you've received $1.2 million in income. When you pass away, the remaining funds go to charity. You've avoided capital gains taxes, got a massive deduction, received more in income than the original value, and left a charitable legacy. The wealthy use these trusts constantly for tax planning and estate planning. The complexity comes in choosing between different types of CRTs, CRAT versus CRUT, and structuring the terms. But for anyone with highly appreciated assets, it's worth exploring.
Loophole number 7. Opportunity zones, the new frontier. Our final strategy is relatively new, but incredibly powerful. Opportunity zones were created in 2017 to incentivize investment in economically distressed communities. The tax benefits are extraordinary. When you invest capital gains into a qualified opportunity fund, you get 3 benefits. Deferral. You can defer paying taxes on those gains until 2026. Reduction. If you hold for 5 years, 10% of the gain is forgiven. Elimination. If you hold for 10 years, you pay zero taxes on any appreciation. Here's a real example. You sell a business or property and have a $1 million capital gain. Instead of paying $200,000 plus in taxes, you invest in an Opportunity Zone fund. The fund buys and develops real estate in a designated zone. Over 10 years, your $1 million grows to $3 million. When you sell, you pay taxes on the original $1 million gain, reduced by 10%, but the $2 million in appreciation is completely tax-free. That's $400,000 in taxes you'll never pay. Plus, you've deferred the original tax bill and received a partial reduction. The wealthy are pouring billions into opportunity zones, gentrifying entire neighborhoods while building tax-free wealth. It's one of the most powerful tax incentives ever created.
Putting it all together. Now, here's where the real magic happens. The wealthy don't just use one of these strategies, they stack them. Imagine this scenario. You're a business owner who qualifies as a real estate professional. You buy properties in opportunity zones, creating massive paper losses through depreciation that offset your business income. You rent your home to your business 14 days per year for tax-free income. You max out a defined benefit plan, deducting $300,000 plus annually. When you sell appreciated assets, you use a charitable remainder trust to avoid capital gains and create lifetime income. This is how the wealthy engineer their finances to build massive wealth while paying minimal taxes. It's not evasion, it's using the tax code exactly as designed. But here's my challenge to you. Don't get angry about these strategies. Get educated. Start small. Maybe you can't do all of these today, but could you start a side business and rent your home occasionally? Invest in real estate and work toward professional status. Look into opportunity zone investments in your area. Consult with a tax professional about advanced retirement planning. The tax code is complex by design. It rewards those who take the time to understand it and structure their affairs accordingly. The question isn't whether these strategies are fair, they're the reality of our system. The question is, will you learn to use them? Remember, wealth isn't built by earning more, it's built by keeping more of what you earn. Every dollar saved in taxes is a dollar that can be invested, compounded, and multiplied. Over a lifetime, these strategies can mean the difference between comfortable and wealthy. I want to leave you with this thought. The tax code is essentially a roadmap for building wealth. It tells you exactly what the government wants you to do. Invest in real estate, start businesses, create jobs, support charities, develop struggling communities. When you align your financial life with these incentives, you're rewarded with lower taxes. That's it for today's episode of Wealthwing. If this opens your eyes to what's possible, make sure to share it with someone who needs to hear it. Remember, financial education is the first step to financial freedom. And please, before implementing any of these strategies, consult with qualified tax professionals. The details matter, and proper structure is everything. Until next time, keep building, keep learning, and keep pushing toward real wealth. This is Wealthwing, signing off.